This episode is brought to you by Plaid. Plaid helps lenders approve more creditworthy borrowers without taking on more risk, combining real-time cash flow data with behavioral insights. It's a fast, familiar experience people trust and that actually converts. Learn more at plaid.com/FTT. Hello, and welcome back to the FinTech Takes podcast. This is the first 2026 episode of Not Fintech Investment Advice, which means, as always, I was joined by the inestimable Simon Taylor, author of FinTech Brain Food. And as we do, Simon and I caught up a little bit about the holidays and what has been happening in the new year. And then we started talking about fintech companies that caught our eye. There was a lot in this episode. We talked about a suddenly infamous stablecoin neobank, who you may know if you've been paying attention on Twitter, AI-assisted home buying and selling and the potential of building an alternate to iBuying, vertical SaaS coming to corporate cards and spend management, and finally, a P2P payments and banking super app that you may have heard of before. All that and a lot more fun. As always, Simon was a delight to podcast with, and I can't wait for you to listen to this episode. So here is Not Fintech Investment Advice. This is FinTech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the FinTech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Okay, new year, but same guy, back for more Not Fintech Investment Advice. Simon, how are you, buddy?
I am really happy to be back. Really happy you're not sick of me yet, sir. Really good to see your face. How are you doing?
I am doing very well. It is lovely to see your face as well. I feel like in some senses, it hasn't been that long, because it hasn't. We saw each other this fall. We were at FinTech NerdCon. We were at a bunch of other events together. We've been doing a bunch of fun stuff. And yet at the same time, I really unplugged for 2 weeks. And I feel like it was this gargantuan gap between last year and this year, just because I didn't work for 2 weeks, which is sort of a novel concept, but pretty nice. I can recommend it. I know you had a pretty productive break, didn't you?
I did just about, but I stopped on the 24th. And aside from doing a couple of bits of writing and vibe coding, which, sort of, I don't consider some...
Yeah, that's fun.
Sometimes writing's a grind, and sometimes you're just trying to play with stuff. And I was really playing with the vibe coding. But I'd say 90% of my time was playing with the kids and just completely unplugged and being outdoors and just good for the soul. So yeah, I got to the Christmas Eve. It felt like I slammed into a wall and then just stopped and barely did anything since. And I feel great. I feel really good.
That is fantastic.
You know what it's like. You create content. Some weeks it's just hard. You're like, the well is empty. There's nothing there. I don't know what to write about. And now I'm like, I could write about this and this, this and this and this. So
yes. No, it's funny. Content as a business, I think, is one of those things that it's a little difficult to describe to people who haven't done it for a long time, because simultaneously it's like the funnest and most flexible and most just do whatever is interesting to you job in the world. Like, I mean, I doubt there are many jobs where people have as much freedom and as much just hey man, just do your thing, indulge whatever you care about. That's pretty unique as a job. And every day I'm like, oh my God, I can't believe I get paid to do this. This is amazing. Combined with just this stuff never turns off. It never goes away. There's always another week. There's always another newsletter. There's always another podcast. And so it's a strange combination of the most grinded out job you could possibly imagine, combined with magical freedom. So yeah, I have a new appreciation for it, having slightly stepped back from it for 2 weeks. And as you said, spent lots of time with the kids. Your kids had a good holiday, good Christmas?
Oh yeah. It had a great one. It was the first magical one. My eldest is 4. So it was really full on, and there's 2 of them and they both talk. Yeah. And there was arguing over who puts the cookies out for Santa. There was getting new toys. There was just, oh my God, I can't believe I got this. Yeah, it's magical, man. I get why they call kids a gift now, because wow. Wow, it was really good. How about yours?
Same. Yeah, we were slightly older, but in the same rough zone that you're in. And you're right. I mean, like they get to a certain age where they really understand and can anticipate what's coming. They're sort of full of like belief and excitement. It's funny. My wife and I always try to limit like the number of gifts because, like, we don't want to overwhelm them or whatever. But you get excited as a parent wanting to give your kids stuff too, and yeah, my kids spent, I think, probably 3 or 4 days sort of discovering things that they had opened but forgot that they got, right? And we didn't even get them that much stuff, but like their attention is just like, I got this.
Yeah.
This is so great. I want to go build this Lego. And so it was a fun 2 weeks kind of discovering and then rediscovering all the cool things that they got and experiences we got to have. So lots of fun.
Oh, man, I'm glad to hear it. Well, hopefully we can unwrap one last gift going into the new year. No, not a prediction show, but a not fintech investment advice kind of show, bringing some gift-wrapped fintech companies.
I was just going to say, yeah, I have a number of ones that I feel will be very fun to unwrap on this show. And I know you were like debating among many different candidates for which ones to bring to this conversation. So Simon, I will let you go first. What's your first company?
Well, the first one's not going to be one of those because the first one is a little company that is building the largest bank in the world, a full-stack stablecoin bank. See, the founder took to Twitter and said most stablecoin neobanks are just bridge wrappers with no real distribution.
Yes.
But Kontigo is different.
Yes.
Kontigo is building its own infrastructure to replace traditional banks. Their infrastructure lets humans and agents transact on top of open networks, brackets, blockchains, and local stablecoins. A startup building for agents for law firms could build the AI native law firm. We're doing the same for banking. Disclaimer, they do include a disclaimer on this tweet.
Yeah, they do.
Kontigo is not a bank. Banking services are provided by the frickin' blockchain. Slow clap.
I love that. That quote that's going right up on my Hall of Fame quote wall right there. Banking services are provided by the freaking blockchain. Yes.
Just pure beautiful. Now, if you don't know why Alex and I are reveling in this one somewhat, there are a lot of stablecoin native neobanks out there that are doing quite well. Altitude, Fuse, Dakota, who had their own little foibles, but seems to be doing really well now. And Fuse, I think I mentioned, and Castcard. There's like a lot of them. And a lot of these folks really deeply respect the banking industry, and they kind of respect everything that comes with it. But then there's Kontigo that seems to want to call out Jamie Dimon. But they've run into a spot of bother quite recently. So first of all, their banking partner, I think it was Checkout, or their sort of banking as a service provider, Checkout. Not Checkout?
Checkbook?
What was it called? Checkbook. Thank you.
Yep.
It's definitely not Checkout. It's Checkbook.
No. Yeah, Checkbook. Yeah, to be clear.
Appears to have deplatformed them, which is something we know the crypto folks don't like. And it also appears in some reporting I saw in the press that there were talks of sanctions violations and issues. Now, the founder also took to Twitter to address some of these concerns, saying, well, look, wait a second, everybody's got this wrong. Checkbook assured us that we were able to open accounts for Venezuelan nationals. And by the way, Checkbook is our virtual account provider. They don't even do our on-off ramping. So, their claims of us having a chargeback issue can't be right if they don't do our on-off ramping stuff. Now, I don't know about you, Alex, but I've been in the industry for a little while.
Yeah.
And I saw something here in their terms and conditions, which is if you go a little bit deeper, their terms and conditions say they're not available to Venezuelan nationals, indeed to people in Venezuela, but that there's plenty of evidence of them actively marketing to Venezuelans in Venezuela.
Yeah.
Now, if you are JP Morgan and you provide the banking services to Checkbook, who provides the on-off ramping services to somebody like Kontigo, you're going to see that and think, oh, this looks pretty bad because Venezuela is a sanctioned country. We're a bank who follows the rules. We can't have that. Let's close this all down and nuke it from orbit. So I don't know if there is a better example of instant karma in the world than the time between the founder's tweet and this happening, or the fact of what happened next, which is just about a week later, they appeared to, they put out a tweet, and I'm translating it using the help of X. We detected unauthorized access that the effect of to affected funds of some users. Your funds are protected, and any affected amount will be reimbursed by Kontigo. They got hacked, and customer funds were stolen, including the founders' funds. So they went from calling out Jamie Dimon to having sanctions issues and being deplatformed to being hacked in the space of about 2 weeks. Now, I don't want to rain on their parade here. There's probably good founders trying to do good things. But what struck me about this is how different it is from pretty much everybody else building stablecoin-backed neobanks, and how much this will become the thing everybody pays attention to, and not the companies building stablecoin-backed neobanks, which I do think is in many ways better than the banking as a service model we had, because at least we have legislation in the form of the Genius Act to be able to make that a little bit more official. So what say you, Alex Johnson? And have you been enjoying this one from the sidelines with your popcorn?
I have, yes. I mean, you always need something to sort of entertain you as you grind away in the content mines, and Kontigo has provided, as you said, so I'm glad that you started with them. I mean, like, there's a couple different elements to this story, right? I agree with you, as always, that, like, in any of these areas, there are people who do the job seriously, and then people who seem to not do the job very seriously, and people who take shortcuts and people who don't take shortcuts. And the ones who don't take the job seriously, who take shortcuts, and then who end up getting dragged into a lot of negative news cycles in somewhat karmic, rhythmic, just getting punched in the face multiple times kind of fashion, does tend to give the overall sort of space they're playing in a black eye, which is, I think, unfortunate. In this particular case, they check all the boxes, right? Comes out of Y Combinator, raises a $20 million seed round. I didn't even know seed rounds came in $20 million increments, building a global neobank powered by the freaking blockchain. The Jamie Dimon part you reference, I tweeted about this. Their launch video, when they were sort of like announcing what they were doing, and we're coming to the US and we're expanding and we're growing after operating in Venezuela, was started by saying, Jamie Dimon, we're coming for you. And I think the first shot in the video was one of the founders without his shirt on in the office. So it almost felt like they were trying to challenge Jamie Dimon to like a wrestling match. And then, of course, like the debanking, or if that's the term you want to use, I think more deplatforming is probably a better one, that actually did at the bottom of the stack kind of touch what JP Morgan Chase was doing, because they worked with Checkbook. And so just like layers and layers of irony on top of each other. I think, Simon, if I was to try to move past all the ridiculousness, the hack is another one, right? Like, what's the point, Simon, of having a global, crypto-powered neobank that's all self-custody if your funds can be stolen in a hack that you had nothing to do with as an individual user? Like, that's not great. The $20 million that you raised having to go to reimburse people for the money that was stolen because it's powered by the freaking blockchain. It's not powered by banks. If it was powered by banks, maybe there's some safety net sitting at the bottom of the system, but no, it's not. We don't need that. So like, it just rings all of those bells. The more, I think, kind of enduring or serious question that I have about this, and it relates to all kind of stablecoin powered neobanks, right, is you're right. In the US, we have the Genius Act. We have sort of implementing regulations that are now starting to be written around the Genius Act. We're going to have market structure legislation fairly soon, I would imagine. So like we're bringing some regulatory clarity in the US, but of course, one of the benefits, and I put benefits somewhat in quotes because it depends on how you sort of execute as to whether this is a benefit or not, of building on stablecoins instead of kind of traditional banking as a service, is that you are global by default, right? You can operate across borders. And a lot of the kind of sort of stablecoin powered neobanks that you see, part of their pitch is, we're working with businesses, we're working with consumers, and they need to move money across borders. And rather than trying to spin up like sort of the traditional infrastructure that someone like a Wise built painfully, year after year after year, we're just going to use stablecoins and it'll sort of be interoperable with that out of the box. Great, that makes sense. The problem, though, is that I think it opens up the temptation to reach into other markets for growth where there might be risk that you're not fully accounting for, right? And this ties to the Venezuela part, right? I was looking at Kontigo's sort of claims about their growth, and they're talking about we've surpassed $30 million in annualized revenue, we have 1 million users, all that kind of stuff. And that sounds great, but if all of those users and all of that revenue is coming from money laundering tied to Venezuela, which is a sanctioned country, well, then that's not great, right? And while it appears to be growth on the surface, and maybe investors who helped kick in the $20 million might be sort of fooled by those top line numbers, like I worry that stable coins as infrastructure will allow unserious founders to sort of hack growth by going places that are just not meant to be banked in a safe way, right? And then I think that worry was always sort of theoretical to me before this example, and this example is making it very real. Obviously, everything that happened over the last week in Venezuela, I think you pointed this out maybe in a group chat somewhere. Maybe not a coincidence that all of this is sort of breaking at the same time that that's happening. Like, we'll have to wait for more reporting to see exactly what all the connections are. But like sanctioned country that then goes through massive political upheaval. Like this is why we don't do these things. And I obviously can't blame Checkbook or JP Morgan Chase for going, yeah, no, I think we're good on this one.
Yeah, you've got to de-risk it, haven't you? They've got an obligation to do the right thing and to try and keep the lights on and to pay the salaries of the people that work for them and to ensure that show keeps on the road. And I think there's like if I was to flip to the opposite side of the argument and say, well, man, we just need money to be free everywhere. The citizens of Venezuela had nothing to do with this. Shouldn't they have access to the dollar? Shouldn't they have access to money? And I have a lot of sympathy for that argument. I really, really do. But the problem is, how do you unpick that from the bad guys? How do you unpick that from the sanctions evasion? And there's a choice you eventually have to make, which is, do you want somebody to do law enforcement or not? Or do you just really want anarcho-capitalism where we all just exist in mercantile fiefdoms, dealing with our nearest warlord? Like, if you take the Bitcoin argument to the logical extreme, the OG cypherpunk argument, you end up there. You don't end up in some sort of utopia where we all just get along and have our own private enclaves and sort of build for the better of humanity. I think that fundamentally misunderstands most people most of the time. And it sort of speaks to, well, I'm an engineer. I have this idealistic vision of this utopia. I want privacy from the man. It would be really great if I built this thing, not realizing what you're building is a great tool for the bad guy, and they will be the first to exploit it. And we saw this with fintech, didn't we? We saw that money laundering was one of those things that kept coming up in consent orders. And it's an easy one to hit banks over the nose with and hope the dog backs down. But it's also kind of always an issue, and it's always a problem. And you can never catch all of it, but you got to have good controls in place. And I just happen to believe that it's a really good thing to live in a world where we don't allow unlimited amounts of criminal money to slosh around the world if we can avoid it. Totally. And that we try and stop it. I would also argue the way we do it is terrible and would probably be a lot better if we use privacy preserving technology. Like, it would be awesome. But you don't do that just by calling out Jamie Dimon and trying to serve a market that's underserved. I've got a piece coming on just like every generation we get a bunch of people from Silicon Valley run into Wall Street and go, don't worry, guys, I've fixed finance. And the old heads like you and I go, are you sure? Because some things might exist for a reason, and I'm all for the disruption. I really am. But like, there's a like, if you understand the first principles of why those things existed in the first place, like ultimately Robinhood clears through the DTCC. Coinbase is now going to clear regular securities. Coinbase itself.
Yeah, I know. Yeah.
You know, like there's just a reality of all of the money in all of the world exists in TradFi. That's not going to go away. You're going to need to touch it unless you are hoping for a nuclear winter and we're all starting again from zero.
Right. And I'm with you. Like, I've never been a huge like cyberpunk sort of like ethos kind of person as it relates to Bitcoin. Like, it always seemed like a very dark philosophy to me as well. And I think that, you know, the other part that you touched on just real briefly there is, you know, it's fine to say like, hey, the ordinary citizens of Venezuela need this. You know, they shouldn't be held captive by these things or whatever. But the reality is, like, they live in a state that is governed by people who ultimately have guns, who might not like US dollar-backed things flooding into their country, or who might require a cut of the money coming in before they allow you to play in that market. Like, there are on-the-ground realities, particularly when you're crossing between borders, that really have nothing to do with fintech or decentralized ledgers or technology. They have everything to do with like local laws and regulations and governments that hopefully aren't corrupt, but often are in a lot of these underserved markets. And that's one of the things about the sort of stablecoin argument that I find a little frustrating or maybe disconnected from reality is they're like, yeah, everyone wants access to US dollars. And it's like, yes, that's true. But they live in places that are governed by people who might not want them to have access to US dollars. And the tension between those two things is real and has a real effect on people's lives. And I think this Kontigo example is a particularly sort of comic and absurd version of that more serious argument, which I think we're going to see play out in other markets, not just in Venezuela.
I do one thing every time I meet a stablecoin founder, which is I pull them aside and I say, please tell me one thing. Please tell me you're investing a lot in anti-money laundering controls. Please tell me that. And if you're not, consider this, you know, just an arm around the shoulder. Mm-hmm. You will go to jail if you don't. Like, please do this. Please do this. Please. I believe in what you're building. I want you to build it. I want you to be successful. Get this right, because I genuinely believe that stablecoins are better, faster, cheaper, programmable, instant 24/7 financial infrastructure for the world. And we could unleash just incredible things if we get that. But we can't have nice things if we have stuff like this happening.
Yeah, no, I totally agree.
Sure, and to a more optimistic one. I just really wanted to do that.
No. I appreciate that. I mean, like, we deserve a treat every once in a while, Simon. And starting off 2026, I feel like that's fair. I'll give you an optimistic one that is very, I won't call it like the spiritual opposite of Kontigo, but it's very different. You ready?
Yeah, let's go.
Okay, so this first one is Givefront. And they are, do you have them on your list? Do you know them?
I'm looking at last week's Brain Food. This is how I do my research for the show.
Really?
And on Sunday's Brain Food, I had the company I was about to read out, and underneath it is Givefront. So I have notes on this one.
Yes. Okay. Excellent. That's so funny because I read your newsletter every week. It didn't clock in my brain that one was one you had already written about. Maybe that's where I first heard about them. I am fascinated by them. So as you know, having written about them, they are corporate card and spend management software specifically for nonprofits. So, nonprofits in the US, there's like 1.9 million of them. They're a big market, right? And much like different segments of the market, they have their own kind of peculiar and specific needs as it relates to things that touch financial services. In the case of nonprofits, compliance and reporting and maintaining your tax-exempt status are very, very important things. And you and I have talked on this show many, many, many times about how the best software sort of considers the last 10% of the user and what makes their needs different from other users. And I think for nonprofits, it's that reporting, tax compliance, protecting their tax-exempt status, just making sure everything is just buttoned up to an incredible degree. However, we also obviously know that nonprofits are, I wouldn't say the most technology savvy organizations. just to put it politely, like they're focused on other things, right? They're focused on solving other very, very important problems. They don't tend to be tremendously tech savvy. I think they tend to cobble together a lot of tools and banking relationships and other things to just get something that works. And then they just sort of like run with that. And, you know, it was interesting. I'm sure you read the TechCrunch article that was kind of talking about them and they're raising some money and all that kind of stuff. One of the parts of that article where they were interviewing the founder that I found fascinating was they said that they initially started with the idea of like, hey, maybe we'll try to sell accounting software to nonprofits. Maybe we'll try to bundle in like banking. So sort of think more of the like Mercury kind of model almost of like, let's just try to take as many things as possible and then bundle it specifically for nonprofits. And what they found was that it's very hard to displace accounting systems in nonprofits. I think partially because nonprofits, like once they land on a thing that works, they're kind of like community banks with core systems. It's like, hey, we don't love it, but it works. And like talking to us about ripping it out, that's just not going to happen. They also, according to the founder, are reluctant to switch banking relationships. And I think a lot of that has to do with just like, hey, we have a bank who's kind of aligned with our mission and what we're doing. Maybe they serve the same community we serve. Like a banking relationship, tough one to sort of change out. But the gap they found in the market was spend management and corporate cards, right? Which is like, I don't know about you, but I kind of feel like the spend management space is sort of like, I mean, it's such an interesting adjacency to break into different markets, right? Because it's like no one really does spend management very well, regardless of what segment of the market you're looking at. And spend management can fuck up all your stuff if you're not careful, right? So like,
100%.
If you want to like make sure you have all of your accounting done well and your reporting is perfect and your projections for we're not going to run out of money next quarter, so we don't need to go fundraise until then, like all of those things are dependent on not only your accounting system, not only your bank relationships, but also like, are your employees spending money the right way? Do you know what they're doing? Are you tracking everything? Are you capturing all of the receipts? Like all of that is also really important. If you don't do it well, can screw that up. And so they apparently view that as kind of the wedge to get into this market. Now, there's obviously all kinds of challenges whenever you're doing anything B2B. Simon, I've been fascinated by watching other providers in this space kind of run up against the limits from a go-to-market perspective, right? Yep. So like, you have Ramp who starts with, we're going to work with these high growth startups and that's kind of the area we're going to play in. And they've been kind of trying to move up market and to sort of change and evolve and adapt to what they're doing. Brex just had the partnership with Fifth Third Bank, and they're going to be powering Fifth Third's corporate card and spend management offering. Fifth Third's not going to do their own thing. They're going to do it through Brex and through this partnership and selling the Brex product. Like, I think you do get to a point in this space where you kind of can't go any further in your target market. And, we've talked about this before on the show. B2B customer acquisition, particularly if you're targeting like smaller businesses, like small B, is really hard because there's 1.9 million of them out there, but they're just scattered everywhere and getting to them is hard. So I have some questions on the kind of go-to-market and acquisition side, but I will say I'm fairly optimistic that even though Ramp and Brex and Divvy and a ton of these other products already exist out in the market, I'm a big believer in the vertical SaaS specializing in that last 10% product hook and product-led growth strategy. What do you think? This episode is brought to you by Plaid. Approving more borrowers shouldn't mean blindly taking on more risk or adding more friction. The problem is that traditional credit data is limited, and cash flow data alone doesn't always tell the whole story. Plaid helps lenders see the full picture by combining real-time cash flow data with insights from the financial tools people already use every day. Those signals come back in seconds through a low-friction experience trusted by about half of US adults. That means you can approve borrowers who are stronger than their credit file suggests, spot risk earlier, and grow without loosening your standards. Learn more at plaid.com/FTT.
Yeah, there's good reasons why. So spend management is fairly well understood, but what's probably a bit less well understood is following IRS 990 grant restrictions and donor policies and building in those blocks. Now, you could configure Ramp to do all of this stuff, but the point is you'd have to configure it to do it. It doesn't just work out of the box. So, and then the center of gravity for a nonprofit is often the grant or the donation, whether they're a charity or not. And then tracking that really instead of revenue. They don't have revenue like a traditional business. So their whole business model looks different. And when you realize that and all of the compliance that follows it, you sort of understand that most of the expense management tools don't fit for that outside of the box. Like you're just going to have to configure the thing. And I agree with it. It's the kind of scaled niche that would do well if they can hit that vein of distribution. That's literally what awesome. I wrote down. Where do nonprofits hang out? Like, where do I go to just, and maybe that's part of the reason they founded this thing, is they already have it. Like, sometimes I wonder, like, do you just go build this because you think it'd be nice to have, or do you go build this because you've seen Ramp and Brex and all those guys, and you happen to know a couple of the trade associations that look after nonprofits? You know, like, that would be what I'd immediately think.
Yeah, I think that's exactly right. And I think that, you know, as with every space, there's legacy systems out there, right? So like, there's Sage, there's MIP, there's these like kind of classic platforms out there that a lot of nonprofits probably use because there's just like a lack of something better. But I am always kind of fascinated by, you know, I live in Montana, right? And one of the things I've noticed living here, but covering the fintech space, is that a lot of the things my friends in fintech get very excited about or notice in the real world don't hit Montana for like 10 years, right? So like everybody, you go to New York or you go to London and everyone uses Apple Pay and no one has a wallet and whatever. And it's like, I got to tell you guys, like in Montana, you see Apple Pay every once in a while, but like we all have physical wallets and physical cards and cash, and like the mobile payments revolution is coming, but it's like 5 to 10 years behind major metropolitan areas. Cause like, you know, innovation just doesn't diffuse evenly everywhere all at once. And I think that lesson applies broadly, right? So like within the world of nonprofits, I think the other thing that's kind of interesting here is, you know, if you're sitting down and saying, all right, we want to compete in the spend management and expense management space. And to the credit of these founders, I think they thought, let's serve nonprofits. They didn't think we'd want to build like a Ramp Brex competitor. So it's a much better way of thinking anyway. But if you were thinking, hey, I want to build something in the spend management space, I want to compete with Brex and Ramp, your first set of conversations you have with investors are going to be like, are you insane? Like, you can't compete with Ramp. How are you going to build a product that's even close to as good as Ramp is, given the density of talent and the lead they have on you and the pace at which they ship product? Like, it's not possible. And the natural response to that, I think the right answer is, look, we don't have to build a product that's even close to as good as Ramp if we take it to a place where they're using software that Ramp hasn't heard of because it's been out of favor in the markets Ramp has been working in for a decade plus already, right? But these other places are still using it and they don't know any better. And so I think, I almost think of it a little bit as like time travel, right? Where it's like, hey, we can time travel to this other time that exists in this other market parallel to our own, and we can bring them spend management capabilities that we think are good, but that wouldn't have a hope of competing in the like pools that Ramp swims in. But if we time travel and take it over here where they're still used to like 2002 software, we can win, right? And so I think that is, again, from a product-led growth perspective, you do have to hit those like veins of where these businesses hang out and, you know, find pockets of distribution. But I do think once you show them this, they'll probably look at you like you are from, you know, the Starship Enterprise and you're beaming down to their planet. Like, it's going to look pretty cool, I would imagine.
Yeah, no, I have a similar thing in the north of England when I go back home. Like, it's kind of cash everywhere. And the thing that was going through my mind was, imagine taking an iPhone to 1997 instead of 2007. You know, like there are the old saying is the future's here. It's just not evenly distributed. And where this is a scaled niche, I wonder about the venture outcomes. I wonder if these people care about the venture outcomes. I don't know what their backing is, and I don't know what their intended goal is. But you could build a very good business in these niches, and they're a great thing to exist. So long may people build this kind of fintech company. This is a sweet spot.
Yeah, no, I totally agree. And just to give a shout out, these guys also came out of Y Combinator. So Y Combinator doesn't just produce the Kontigos of the world. I wish that they produced zero Kontigos, but these guys also came out of Y Combinator. And so there's your tie between our first two companies. Simon, give me your second company.
Okay, this is called Beycome, I believe, Beycome, and it's the AI-assisted home buying journey. They charge sellers a flat fee to list their home, close, and to list their home and close it, and it aims to save sellers on average $13,185 in fees while improving the overall experience for buyers and sellers. For a flat $399, they'll take 25 HDR pictures, list with NMLS, and make a virtual tour YouTube video for you. So pretty much everything your real estate agent would do for you. And I saw this and I thought, well, this looks like an upstart challenger to Opendoor. They're going deep into title and insurance and appraisal and even drone tours, like all of that stuff that you just it'd be a nightmare if you ever had to do this by yourself. So you just let somebody take $13,000 for the privilege. And this is the kind of stuff that like the human agent does and makes a lot of fees for. Having an AI agent do more of it progressively over time makes a lot of sense. And maybe there's room for somebody other than Opendoor to do it. Not sure I see what the AI is doing specifically, because they say we're AI-assisted home buying journey, but like where and how isn't really disclosed. So it's a great tagline, but I can totally see it being a software-assisted AI-powered buying journey, and with lots of integrations needed under the hood, it's pretty smart to have put all of those pieces together. But when we had Kaz, the CEO of Opendoor at FinTech NerdCon, he was saying, look, he sees so much opportunity for AI because so much of it is like PDFs and unstructured data and terrible photographs. And this is the kind of stuff that today AI is pretty good at, actually. You don't need an API for everything. You can just take that really ugly document that came out of that law firm that one time and an appraisal and make sense of it and do a pretty good job at it. So I think it's entirely possible that we could see maybe this company, maybe Opendoor, maybe others start to get some real traction if they can solve some of that like distribution challenge. Because again, in Montana, if you were going to list your home, would you use this or would you use the guy down the street? But the Montana natives are going to be for some time probably using the guy down the street. Yeah. But I think for everybody else, and especially for those that are a bit more AI pilled, it's kind of interesting to think about this journey. And in the history of things that are like all-time high levels of pain, high levels of stupid, the home buying journey has to be right up there with the pain threshold. So good on somebody for trying to fix it.
Yeah, no, that makes sense. I mean, I think that, it's interesting because there's kind of two different paths maybe on this problem, right? Because I think the problem is a fairly stated one, right? And I'll illustrate it with a personal anecdote. I am really, really strenuously hoping that I'm never going to have to buy or sell a house again, but I have at various points in my life, and it's not a fun process. And in particular, one of the things that struck me as really fascinating about it was real estate agents are sort of like both very good at trying to make you feel like they're your friend, while at the same time being like some of the most coin operated, sort of like ruthlessly pragmatic people you'll ever meet in your life, right? And so like, you buy a house and they send you like a little gift to congratulate you on closing for your house. And it's a cutting board, but there's a QR code on the cutting board and their phone number in case you ever need to buy or sell a house again. It's like, well, I don't really want a cutting board with your contact information on it, right? And it's like, it's both really thoughtful and also like deeply like crass and annoying. I had a real estate agent that I worked with for years, and I was looking to buy a cabin, and then we looked at a couple, and I ended up finding one on my own that I bought, and I didn't tell him. And then he found out about it later, and you would not believe how mad he was. And I'd known him for years, but like he really felt like I was taking money out of his pocket, right? And it's not to say that he's not a good guy. It's just to say that like there's this very weird blended set of incentives when humans get involved in real estate transactions. And I could see consumers over time, even in Montana, getting to a point where they're like, you know what, I don't really like this. I don't enjoy the experience. I would prefer to just, and you know, the way that Beycome talks about this on their website, they kind of say like, you already do a lot of the work. Why not just keep all the upside? Like that is a compelling pitch to me. I think the interesting thing, contrasting these guys with Open Door, which is fascinating, is my sense, and you can correct me if I'm wrong because you've talked to Kaz more recently than I have, but my sense with Open Door is they have more of like a network effect approach to this, right? Which is to say, like, you tell us that you're looking maybe to sell your home. We will run all the numbers and do all the magic behind the scenes and give you a cash price for your home. And if you just want to skip out on all the stuff, we'll just buy it for you. And then the benefits of their system are we simplify the transaction. You can just walk away and make it easy for you, the seller. And then they have a network of buyers and ways to sort of like arbitrage the difference between those two things. And it's a model built on network effects, right? You have to have enough sellers, you have to have enough buyers, and you have to have enough data to price all the transactions. And that's kind of how they bring how they solve that problem for buyers and sellers. Beycome, and maybe I'm wrong, maybe it's early, but just looking at their website, this almost feels like more of like a do-it-yourself kit for buyers and sellers, which is like much more of an individual way where it's like, hey, you want to sell your house. You actually want to like sell it. You actually want to like have your hands on the wheel, so to speak, and like do the work yourself. You want to keep the financial upside of going through that process. It's not maybe as convenient as the iBuying route of like, here's a cash offer, just do it and like we'll simplify everything, you can walk away. But it's also not like, hey, work with this real estate agent that you don't necessarily totally trust to have your best interest at heart. And so it's like maybe trying to forge kind of a middle path. I mean, again, as we do on this show a lot, and as we did earlier in this episode, I kind of come back to like acquisition and how do you get this in front of home buyers. And that's the benefit of being an Open Door or Zillow or any one of the providers that's already big in this space, is they've reached sort of a saturation point where people will sort of just come to them. But I'm intrigued. I wonder what the go-to-market path is. Like, who, I guess put a different way, if you're a homeowner or a home buyer, who do you give early signal to that you're maybe looking to sell or buy? Like, who could say, oh, well, you should just use these guys? Because normally the real estate agent is the first call. That's their whole job, is to get ahead of the transaction as much as they can. So like, I guess in some senses, what I'm wondering is, how do you front run real estate agents?
Oof, yeah, that's a tough network effect to go fight against. Maybe you could send chopping boards without QR codes on them as a starting point and just like not be weird. I mean,
I like it.
There's always been so much money in real estate, and whenever there's a large profit pool, you have to wonder why. Where did that profit pool come from? Why is it so ridiculous? And somebody's winning if you're losing. And so I wonder about that as well. They're probably going to need a big direct-to-consumer marketing push, which is going to be expensive. It's hard to do. We had at FinTech NerdCon, Melissa Alvarado, who built all of the direct-to-consumer go-to-market for Chime, and they got that engine working. They were probably one of the first fintech companies that really figured out that acquisition channel through, sort of ads and marketing and member get member and all that sort of stuff to really drive some of their early usage. That's hard. Like, it's really hard to stand out in this market. You know, you've got all of the Zillows, the Redfins, the Better.coms, the Open Doors sort of overlapping with it, but certainly to an unsuspecting eye from a distance, how do you tell these things apart and which do I use for which problem? So I think if you could nail that go-to-market, you'd have a chance. But I have the same question. It's like, how do you stand out? How do you compete with that go-to-market? Hey, Tesla did it. Tesla did it with this product that's just weirdly different, and we don't do dealerships. And the dealerships initially tried to like mafioso them and screw them out of that existing, and then they just did it anyway. So maybe it's just about building your own distribution. That is hard to do, but if you do it, it's durable, and then you've got a heck of a moat.
Yeah, no, I think that's a really good point. I also wonder a little bit if there's like a relationship with banks, you know, to be had where it's like, hey, let's just like, because you're going to need the bank involved, right? Whether it's I'm selling my house and I have a mortgage on it. Oh, well, you know, here's another route to go if you want to sell your house. And it kind of goes through the mortgage servicer. Or, you know, if you're buying, you know, you could skip a lot of the like, mortgage, real estate agent, broker, like you could skip a lot of those things, but eventually you have to land on a lender who will loan you money to buy the house. And so I wonder if like when we talk about cutting out, it's almost a question of like, how much do you cut out? And then where do you draw the line? And maybe where you draw the line then becomes distribution partners or ways to like work together. So yeah, I think that'll be an interesting one, but I like the idea of an alternative model to changing the home buying and selling experience. I think iBuying is great for people who just want like simplify it for me, give me the easiest thing and I'll walk away. But as we know very well, Simon, like there's a different segment of consumers who like, it's almost like if you make it too easy for them, especially for a transaction like a real estate transaction that's just a massive financial decision, they sort of won't trust it, you know, and they'll like want to have their hands on the wheel. And this feels like a solution built for that segment.
100%, man.
All right, Simon, I'm going to cheat a little bit. Not totally unlike you did with Kontigo, since we were having some fun at the beginning. But let's wrap up with one that's a little bit different. I want to talk about a company called Cash App. I think you're familiar with them.
No, I have heard of them. They're sort of part of the Block family, I believe.
Yes, exactly. And obviously, I think they've probably come up over the years in our many conversations. The reason I wanted to hash them out with you just for a quick second, though, is there's been a real vibe shift at Cash App in the last, and I guess Block generally in the last year, 6 months, 3 months, like velocity is increasing again. And Jack has talked publicly about this as like, this is the new Block. This is what we do. But I wanted to talk about Cash App because they had like a slew of feature releases. So many that I kind of had a hard time categorizing all of them. But I just wanted to bounce a few off you and see what your thoughts were, because they seem to be taking the product in some very interesting directions. So you ready? I'm going to run you through a few quick ones.
Go right ahead.
All right. So they launched a new sort of integrated benefits program that if you transact or direct deposit or do certain things at a certain threshold, you now get access to sort of improved benefits, rewards, interest rates, primacy when calling for customer service issues. And we've seen this across a number of different neobanks, like Chime does something similar, but sort of trying to concentrate on capturing more primacy. So Cash App Green, that's one. Two, they've really pushed their foot down on the pedal on all things lending. So obviously they have Cash App Borrow, which is their short-term lending product. I actually was recently like pre-approved in Cash App, so it's made its way to Montana, which is great. I think they're in now 48 of 50 states. So they've rolled out Cash App Borrow more broadly, and I think are trying to scale that up. They also have better integrated Afterpay into Cash App, which was always something that I thought was a little weird after splashing down a ton of money for Afterpay. Like it kind of stubbornly stayed its own product rather than being integrated into Square and Cash App. But now it's sort of an embedded option within Cash App. You can use it with Square sellers, obviously. You can track all of your Afterpay loans within the Cash App environment. So they're sort of more tightly integrating that. I wrote a whole piece about their new Cash App Score that they're starting to make visible to Cash App borrowers and Cash App consumers, where you can see essentially the Cash App equivalent of your FICO score, and you can get information on how your behavior in the Cash App ecosystem better positions you to be able to borrow from Cash App. They've even talked about maybe making the Cash App score something that's available to other lenders to use to originate Cash App borrowers, which is fascinating. They continue to make improvements to the core P2P payments product. So they rolled out pools, which is the ability to create like kind of multiplayer P2P finance for or P2P payments for different projects or different trips or different kind of group activities. And then finally, because it was 2025 last year and now it's 2026, they have MoneyBot, which is an AI assistant that sort of lives within Cash App that can answer questions about your finances within Cash App. Kind of, I guess, directionally similar to surfacing the credit score, where it's like, hey, we want to help people understand what they're doing in the Cash App ecosystem and use all that data to help them sort of better navigate that ecosystem. So, Simon, I don't know that I've heard you anywhere talk about or read in your newsletter what you think about all this Cash App stuff. So what do you think?
I did very briefly cover it in a Things to Know, like a month or so ago. And I focused mostly on the stablecoin news and the AI news.
Oh, right. That's another one. Yeah.
Yeah, so they're launching a stablecoin. There's also like a whole slew of people going out just like Bitcoin pilling Square sellers.
They really are,
and it's like quite incredible to watch the network effects of that and the incentive mechanisms involved in it. And look, true story. About 18 months ago, I had kind of a phone call with somebody that was a product leader over at Cash App, sort of saying, what features should we be shipping, Simon? What should we do? And I said, well, it's really easy. Just go make a list of every nice feature you've ever seen and then figure out how you can deliver them extremely quickly and do it in an integrated way to not be Venmo. Now,
yeah,
what I said was not insightful. It was just like, don't suck. The real skill of that product leader and everybody at the team is to go execute that. And I think it took maybe a founder coming in, removing some of the internal walls to unlock that kind of velocity. But I wrote a report, 5 years ago, saying that product velocity is a power law in fintech. Possibly the fastest shipping fintech company I can name right now is somebody like a Robinhood. If there is something somebody has done, Robinhood whacks that mole right away, and they've shipped it too. Somebody did a prediction market, done that one too. Somebody did a credit card, done that one too. I want you to move your 401k to us. Just shipping incredibly quick. And the companies that ship features faster are also the ones that grow users faster and grow revenue faster. It's a correlation, not causation, but I think the correlation is kind of uncanny. And if you look at the classic refrain at PayPal is it's 15 different companies in a trench coat at this point. You've got Braintree in there, you've got Venmo in there, you've got the legacy PayPal business, you've got the branded checkout, the unbranded. These things don't fit together. And Venmo's sort of started to show some signs of life, but nowhere near this Cash App pace. And maybe in the early 2010s, Cash App and Venmo were both growing incredibly quickly, and they were exciting companies. And then somewhere in the pandemic era, they both just kind of stopped. And the hardest thing for any big company to do is integrate all of their stuff neatly and tightly, because underneath that glass of the mobile app is spaghetti. And getting all of that to fit together is extremely hard to
there's people.
That
they're different teams too, right? They're people who don't necessarily want to play nicely in the sandbox together. And I think that's been a big project for Jack, is just getting people to play nicely together, work together.
And to grasp that nettle, to do it and to stick the landing, I would love somebody to do a tell-all about how they got that done. Because the market's not rewarding it yet. If you look at their stock price, again, not fintech investment advice.
Right.
But my hypothesis would be, given this velocity, it's a matter of time until that shows up in the metrics. And now, for a long time, I said you want to build a neobank, you can just go copy paste Revolut's like last quarter of things they've shipped or their roadmap, and you're probably going to be better than 99% of them. Cash App's in that conversation now. Like, they really, really are. And the reason Revolut works is because most people in the US have never used it. So they go, oh, what's this? And then they discover a bunch of features they didn't know people have. Same is true now, I think, for Cash App. It works the other way. There are so many little details here. And so I love what they're doing. So I am manifesting some good outcomes for that team. Like, I hope they had a good holiday break, because shout out to everybody. This is why I do what I do, actually, is I've been that person trying to ship that thing, and I know how hard that was to get done. So can we just pour some love on all of the people that made that happen? Because that is not easy.
Yeah, I will double up that shout out. I think, they've done a pretty remarkable job of kind of just picking up the pace, and as you're saying, like, that's the hardest thing to do in work. That's the hardest thing to do in life, is changing the pace at which you do stuff. And, getting that pace up and being able to, as you say, like, they have such a natural advantage. They have such a large ecosystem. They have so many active users. There's such a huge opportunity, but to capitalize on that opportunity fully, and I agree, this will show up in the stock price eventually, you have to get that velocity up. You have to be able to sort of take all the best things you see out in the market and incorporate that into what you're doing. And I see a lot more evidence of that at Cash App. I see a lot more evidence of that at Square. I see more pragmatism, quite frankly, from Jack, which kind of goes to your stablecoin point. I never thought in a million years anything but all Bitcoin would be happening. And so I just think, like, across the board, you're seeing lots of interesting signs. So it's not just startups moving fast and doing interesting things that we cover here at Not Fintech Investment Advice.
I am so about this. I'm manifesting more episodes at this point. Can we do more?
That is a great thing to manifest. I love that. I think we should, Simon. I think maybe 11 more at minimum. Does that sound okay?
That sounds like a plan, my friend. I hope we get to do this soon.
All right. Well, I look forward to it. We'll have you back again next month. As always, Mr. Taylor, a delight to talk to you. Happy 2026, and we'll talk to you again soon.
Stay classy.
Thank you for listening to this episode of FinTech Takes. Stay up to date with emerging companies and the latest FinTech trends by subscribing wherever you get your podcasts. And if you love FinTech Takes, please tell a friend.